GETCRACK. Wake up, motherfucker.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should.
Alrighty, it is November 26th, 2024. Couple days till Turkey Day. Uh-huh. If you've been shorting MSTR, good for you. Keep shorting it, I guess, but I will put some caveats now. I am going to say that it could be time to swing long on crypto stocks. All right, so let's look at the chart. Let's look at the chart for Bitcoin. And it's time to stop shorting MSTR, I guess, baby. Yeah, so this is Bitcoin right now. 40-minute chart. If you look at the 4-hour chart, we are stretched far away from its 18 simple moving average. Now, it could go down to 89,500 or 90K. I mean, that would be the logical destination. But if we look at the daily chart, you see it's 18 moving average, 18 simple moving average. It tapped it. That's a logical place also to stop. It's going to slow down. So even though, but like here, you look at the daily MACD, it's already crossed over. It doesn't mean it's going to go down, but it's probably likely at least going to go sideways into Black Friday and into next week, most likely, unless the weekend gets a big pump. And then when the markets reopen for December, everything will reset because then all the options will be done. But it could still have trouble on Monday. On, let's see, Monday the 2nd, okay, December 2nd. But for MSTR itself, if we look at it, it pretty much almost hit my target. I said $325 around there. It almost went there. It almost went there today. It just completely fell apart. It was quite shocking to me. I thought we were done. Like I would short it up until like 370-ish, and then it will be done. People will start trying to buy, but nobody was willing to hold it. 2 times today it held it. It tried to hold it, and then it just completely collapsed. Well, yeah, there you go. That's why shorting is so exciting. People love to short for that reason. It's easy money. Like if you went and used the reverse ETF, inverse ETF, MSTZ, and you got in the morning, $1 to 135, and you got out of the top exactly perfectly, then that's 35% in one day, doing that way. And if you did options, shorting it, like I'm sure you could figure out some options that would have netted you even a crazier win if you did it right. But I don't do options. I don't want to overcomplicate myself. And shorting is such a dangerous game. Like anything could easily reverse against you. And I'll tell you this, like when you look at this chart here, let me do the 13 minutes. I use 13 minutes here. When you see a downtrend going this way, you follow the trend down, but you can also trade the counter trend. So like when back on Monday, when it went down and hit the 380 area, you could have longed it. because it stretched so far away from the moving average. You could have been like, well, it's going to bounce. And if it bounces, I'll go long for a little bit and then re-short. And then you do the same thing down here when it went to like below 383. You would have been like, oh, it's getting too far away from that moving average, that blue line. You're like, okay, long it again, re-short it, long it again, re-short it. Yeah, you could do that if you're really fast. That's called a counter trend trade. And I mentioned it like maybe once at least with the Joe Rabel's video. I mentioned that. So that's one of the things I probably should have to emphasize when I do my teaching again. When I do teach, because I'm trying to figure out what stuff I got to redo over the October streams and do actual like lessons, like a school or something, because I have to teach you like, okay, there's a trend trade, you follow the trend down, and there's also a counter trend. And the same way with the stock moving up, when the stock is stretched far away from two parallel lines of moving averages going up, you kind of go like, well, okay, now it's gone too far away from it, it's going to have to reverse, take a dip, buy it back, go long again, take a dip, go back. So you can do it the same way, opposite way. Shorting, you're just going this way down. Okay, so we can let me see if there's an example of that. I guess I could use hymns, huh? Hymns. Let's see. Let's do 65-minute. Yeah, this one's too volatile. Let me do the weekly then. Like you see this on the weekly chart, it goes up, it gets far away from the two moving averages on the weekly, and then it pulls back towards it. Then it gets stretched away, it goes back towards them. Stretched away, guess what? It probably will pull back. Okay, so hymns, it'll pull back again. But you know, it's over the $24 mark. This is a very significant area, but yeah, it'll probably retest it eventually. I think it's way too stretched on the weekly. The daily, yeah, also stretched away. So yeah, they always pull back and then you buy, you go back up, you sell a little bit, you go. So you can keep a long position, but you can also trade around it. You could just like, well, you could buy a put or something or sell a call on your position and do the same thing that way. So you can protect yourself when it gets too stretched away from these moving averages. So same thing, going up or down, you know, shorting or longing, it's the same way. And it's just the opposite of each other. Okay, I got to discuss SMCI. So we went down today. I think we had some trade war news finally from Donald Trump. So he wants to do 25% tariffs on Canada and Mexico. And he said something about China as well. So semiconductors definitely very affected by how its dealings with China. So I think it took, well, actually, in the morning it was up on ADI earnings. ADI earnings were up, but then it just completely reversed. So either the news from ADI wasn't good enough to sustain any new buyers, or because the Trump news in the pre-market kind of overridden everything that came from it. I have no idea yet. We have to wait and see. So it's important right now where the semiconductors are at, because that's the only way we're going to push higher on the NASDAQ. NASDAQ, the QQQ is fine. It was up today, 0.54%. We got $509.31 on the QQQ. It looks fine, but if you want to go higher and make new highs on the QQQ, you better get this thing reversing. And it makes sense for it to drop here too, because it's touching this downward daily moving average here. That's going to be a headwind for it. And we just finally crossed over 217. So it's going to fight here before trying to move on into 223, 228, and further up. So if you're doing SOX L, if you got in 27, yeah, I'm just holding it. I'm not sure if I'm going to change my mind on this. So if you're doing the 3X ETF, SOX L, yeah, you just keep holding. And so then that's related to SMCI too. So people are going to take profits, right? And this is the good place to do it because we're in between the gap. So when all the bad news came from SMCI, it started way early, but accelerated in August. And then again in October, it just completely got so much bad news that we've gone full circle here. right? We went right back to where we started, and now you're going to see a fight. Everyone's going to fight. So that's why I said, look at FMCX. I think we're safe right now. Man, this chart is messed up. I don't know what TradeView is like, screwed up the whole data here. Oh my God, I don't know what it's doing. So ignore that. This is wrong. You see this jump here? That's this. I don't know what they just did the wrong math or something here on TradingView. Anyway, you can use SMCX. That's 2x SMCI. So I would say like it's time to get more risky. Okay, so wait a while, see if it stays within. So we got yesterday, we got over 35, we closed above 35, we pulled back. I'm expecting it to try to stay near 35 before pushing to 40. And then once we get to 40, we finally can get to 50. And if you're going for that swing trade, yeah, look at SMCX for the added boost. You can use less capital and use that instead. Or you can use options, right? If you know how to use options, then see if there are some SMCI options that are better suited for this. But I would try to reduce my capital because this is already a lot of gain from here. So if you were here buying between 28, 25, 20, and then down to 18, you're probably like average. On average, you're probably up, what, 60, 70%. That's already good for a couple weeks worth of work right there. Yeah, what's up, Gary, and what's up, Jewel? Okay, so today I want to talk about some articles. Just one article, and I'm going to play a video, okay, with one of the best traders on this planet right now who's living. And before I do that, let's talk about some other stocks I wanted to mention. Like last night, I was saying like this electric vertical takeoff landing drone sector is pretty good. So Joby Aviation, look at that, because it's been moving for this whole month. It looks like it wants to keep going. So I'm going to be watching this one for pullback to buy. So this is one of those trash speculative type stocks. The other one was, let's see, Joby. We have Archer. Yeah, same thing. ACHR, Archer Aviation, and Blade. Let me look at Blade. BLDE. Blade Air Mobility. High volume past 2 days. Reversing this loss here. Pretty volatile. I don't know. I'll have to keep my eyes on these three. So they could be pretty good. And the other stocks, the bottom feeder stocks I mentioned yesterday, TDOC pulling back. So watch this. Maybe there's another entry coming soon. NVTS, okay, pulled back today. Also watch for an entry. And yeah, I mean, I don't know what other ones we had. Oh yeah, talk about Mexico. I'm gonna talk about Mexico. EWW is the ETF. So it's dropped right back the same level as election day when Trump won. So now I'm interested in buying this again, because the first time when Trump got elected, news on the opening day after the elections, I traded that for a couple days, got out up here 53. I used MEXX. This is the 3X ETF for it. So if you want the leverage, you can use this one. I don't know what the options market looks like for EWW. Maybe it's not clean or liquid, and you can get this one. Yeah, so I am definitely interested here. So it's below 10 right now for MEXX for, I think, for the longer swing. So this is not going to be a quick trade. I want to start buying a bunch for a larger swing into next year. I think the tariff stuff, yeah, it's always overblown, the news. They'll try to make it sound more negative than it should be. So watch for the emotions to get high, and you can scoop up a bunch. And let's look at one stock. CMEX, so that's Mexican cement, so it's down, back down below this 5.5 area. So this could be another stock that might be worth getting into because it could recover with home building and all that in North America accelerating. So that might be good. Now, GameStop. Damn, it got to 32 and pulled back. Oh, it finally broke out of that 29 area. It finally poked its head out. Man, we have earnings next week, I think on the 4th or something. December 4th. Yeah, I guess that's where it is. I'm not sure if this is the official earnings date or it is estimated. Well, I'll have to see when we get closer to it. But man, it almost started running. It got to 32 almost, but it stopped right there. Dang. Once we get past this area, yeah, this thing will just fly. There's just if there's enough shorts to squeeze this again, yeah, it'll just fly back up to the 40s. I'll probably get out of there and be like, that's done. I'm done with this trade. So I got in around 23, added in 25. If you were really scooping it up early in 20s, you already got 50% gain, and so you're sitting real nice, and you can afford to wait and see if this thing get to 40s. That's a really good exit point to get out. All right, so that's a good trade there. All right, I think that's it for that. Now let's read the article. Okay, so I'm gonna play the background music. Oh, I gotta discuss the long first. So MSTR, you can start going long now for a swing trade. You can keep trying to short it. Maybe it'll go down to 325. So you can day trade a short, but start thinking about taking your profits and going long and just hold it. MSTR, or you can use MSTU. So this is 2x MSTR bull. So I bought some today down here at 130s and near 140, 130, 140, this area. So this is equivalent to, and okay, I'll give you the risk right now. So let's say you bought around when MSTR was 340. So if it actually crashed again tomorrow or Black Friday to 325-ish, that's about 5% down from the low today. And that's about, like, let's say tomorrow it holds this area. Let's say it crashed from here. That's 7-8%. That's about 25-ish percentage. Let's say around average 25% you're risking. If you well, no, it's not times 3, it's just times 2. So that, okay, 15%. Let's say 15%. So if you're MSTU, then you're probably, and we're going to average, let's say you bought around an average cost average of 136 or something like that. So 15%. So it could go down to 115, right, from this area. That's the risk you're taking, but it's worth the risk because, like, if it pulls back up, that's 37 or 40% up the other direction. So you're taking a 15% risk for 40% gain, maybe. If we go in a straight line, that is. Let's see. 15. Yeah, about 30% maybe. Maybe I'm too optimistic about the 40. Let's say 30%. All right, 30% gain. All right, for 15% risk. I don't know. Is that risk really worth it? Yeah, we'll see. We'll see. So I took a stab. I'll take the risk. I'll take the risk. All right, guys. Okay. All right. So let's play the background music. Present the article. This is a long article, but I think this is worth the read. Worth the read. And the article link is on the description. You can get it in the description. I'll put it in the chat. Okay. Right here. A secret cycle. Right, this was published in October 12th, 2009, by the New Yorker. Okay, author is Nick Palmgarten. Palmgarten. All right. The education of Martin Armstrong, according to Martin Armstrong, commenced in 1964 when he was 14. He got a weekend job working for a bullion dealer in Pennsauken, New Jersey. I think Jules from New Jersey, who initiated him into the idiosyncrasies of the trade in coins and gold. The next year, he bought several bags of rare Canadian pennies, which turned out to be even rarer than he thought. Within a year, they shot up in value. A roll of 50 was worth 1,000 American dollars. Since he had roughly 1,000 rolls, he became, for a brief spell, a teenage millionaire. Expecting, as people do, that the penny's price would keep rising, he held on to them. But the high price precipitated the discovery of a greater supply. Their value plunged, and he was once again a regular South Jersey kid working weekends in a coin shop. Armstrong's father, a lawyer and polymath whose grandfather had lost a fortune in the 1929 crash, disapproved of speculation. And he persuaded his son to put his diminished fortune in a fashionable but conservative investment vehicle called a mutual fund. Not long afterward, mutual funds, along with the broader stock market, abruptly crashed. Yeah, that's great. Armstrong began to observe that many things work like this, that occasionally a contagion of indeterminate origin passed through the system, hitting one asset class after another. One summer, his father took him to Europe, and the web of foreign currencies gave him a tactile sense of interconnectivity and the oscillations that might come of it. The following year, Armstrong's high school history teacher showed his class the 1937 film The Toast of New York, about the Black Friday panic of 1869 and the gold speculator and con man Jim Fisk, with a young Cary Grant as Fisk's accomplice. At one point in the film, Fisk quotes gold at $162.50 an ounce. Armstrong, aware that the price in 1966 was just $35, assumed that the line was Hollywood nonsense. Prices could not possibly have fallen so far over the span of a century. He went to the library, however, and found on microfilm. Okay, you guys, do any of you guys know microfilm? Microfiche? I mean, I'm old, but dude, there was a time when you could only read old newspapers on these things called microfilm, microfiche. All right, you can look it up. There were these machines. The libraries would save all these newspapers in these little tiny little things. You know, like, I guess, you know, they had those old projectors. Yeah, you know, it's kind of like a slideshow. Yeah, kind of like that. But these were really tiny, and they would zoom in using these machines to read them. So they would print them in these tiny little slides, and you could read them that way. Anyway, a contemporaneous reference in the Times to a gold price of $162. It further demolished his youthful assumption that assets gradually appreciated over time, that markets were linear. One day in a newspaper, he came across a list of financial panics that occurred between 1683 and 1907. On a lark, he divided the span 224 years by the number of panics, 26, and found that on average there had been a panic every 8.6 years. As he read more, he began to suspect that 8.6 was a highly significant number. He discerned a reoccurrence of major turning points in the economy and in world affairs that followed a distinct and unwavering 8.6-year rhythm. 6 cycles of 8.6 years added up to a long wave cycle of 51.6 years, which separated such phenomenon as Black Friday and the commodity panic of 1920 and the Second and Third Punic Wars. All right. Now, I've talked about cycles so much in the past, right? I mentioned that everything moves in cycles. And after I read this article, I'll show you a film, a documentary that's been taken away, hidden. I found it on YouTube. It was played on PBS, but people do not want you to see it because that kind of gives away the edge, of this. Let me zoom in. Armstrong was for the most part self-taught. His father had him reading Aristotle at the age of 9, which along with movies like Cleopatra inspired him to delve deeply into ancient history, the arcana of Mesopotamian commodities, the decline of the Roman denarius. After high school, Armstrong attended the RCA Institutes, now called the Technical Career Institutes, and he audited a few courses at Princeton, but he never earned a college degree. School bored him. Still, he adopted the habit of a learned man. In the early 70s, he became a trader and dealer in gold and began compiling forecasts about commodities and currencies, which he sent out via telex. Oh man, that's even more boomer. Telex? I'm not even going to talk about that. All right, to clients around the world. Over time, the forecasting became his business. Much of it was rooted in cycles research. He traveled to London, to the British Museum newspaper library, and put together historical data on prices and exchange rates down to the day. He constructed what he called an economic confidence model, which he relied on to predict an upturn in the price of commodities in the early days of 1977. It worked, and he was amazed. He opened a forecasting firm called Princeton Economics International, based in Princeton, New Jersey. His model singled out in advance the day of the October 1987 crash. Now, this crash was very infamous. A lot of boomers remember that day, Black Monday, and they never forget it. That's why you see a lot of people scream and yell and say like, oh, stock market, blah, 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 dangerous, dangerous. A lot of people somehow remember only the worst times in the stock market. But outside of those crashes, the US stock market tends to go up, right? So, human psychology is always transfixed on these moments in time. And this is what we should study, okay? All right. Never did I suspect this to work on such a precise time level, he wrote later in an essay called Understanding the Real Economy. It made no sense. I personally assumed it was just a fluke. This took place on the minor halfway point up the first leg of the 8.6-year cycle at 2.15 years. Afterward, he was messing around with numbers and realized that 8.6 years was exactly 3,141 days. 3,141, the number pi times 1,000. The cycle mystery had deepened. If pi was essential to the physical world, perhaps it somehow governed the markets or the fluctuations in human behavior and mood that manifested themselves in the markets. It was, after all, the magic number associated with the swing of a pendulum, Heisenberg's uncertainty principle, and the Great Pyramid of Giza. Why not the vast monuments of data known as the financial market? Suddenly, I saw it within my mind's eye, he wrote. There was a geometry of time itself. All right. I think there was a movie, right, called Pi. Right? It kind of did that schizophrenia type stuff. Humans are so good at looking at patterns and things. And if they're so good at recognizing patterns, I'm assuming they're going to create patterns themselves in nature. All right. Fascinating. Although I'm curious what natural cycles would be like without legacy family money at the top of the market. That's what Jules said. Yes. I think, people are still human, either rich or poor. They're still governed by psychological effects. And even with the advent of AI right now, we still control how AI is used, right? So the human influence, the human conductor is still there. So unless only robots traded with each other without any human intervention, then I would say, yeah, none of this stuff should make any sense anymore in this technological age. But I say it's probably going to make it worse. Anyhow, let's continue with the article. Pi suggested some future turning points, which Armstrong watched carefully as they approached. Among them was December 1989, which marked the Nikkei's peak before it crashed. Nikkei is the Japanese stock market. This call earned him the Magazine Equities Award as the top North American economist and a big following in Japan, where the idea of cycles, a tenet of Eastern belief. Oh, yeah, you know that feng shui, all that stuff. The I Ching. Yeah, you toss some coins and some sticks and try to figure out all that stuff. And, even Chinese horoscopes, it's not just a 12-year cycle. It's also like by year, by month, everything, by week even. So you can look like at it everywhere. Yeah. So if people believe in these things, if there's such a strong belief in it, and it controls their nature. So I might not believe in any of that stuff. It's pseudo whatever, quackery. But if there's a large following of people that believe it, then why not it be true? Because if there's enough people that believe, it will be true. That's what I kind of say about how markets work, Anyway, a tenet of Eastern belief did not seem far-fetched. He presided over conferences in the ballroom of the Imperial Hotel in Tokyo and began investing billions of dollars on behalf of Japanese clients. He boasted that the Japanese called him Mr. Yen. Another big Pi date was July 20th, 1998, which turned out to mark the high point in the S&P just before a Russian default broke the giant hedge fund long-term capital management. Ooh, this is a famous one too. Long-term capital management. This was kind of like the Lehman Brothers before the 2008. This was the 90s version of Lehman Brothers. So you can look up long-term capital management, all right, yourselves, and nearly wrecked the financial system. Armstrong by now was running a couple of hedge funds, and the Magnum Hedge Fund reporter named him Fund Manager of the Year. Not long afterward, he claims, the CIA telephoned his firm, eager to get a closer look at his model. Agents had been watching him and were curious about how he had managed to call the collapse of the ruble. They asked if he would come to Washington, he said, and build his model for them. He declined. Finally, in 1999, he published a report, his last at Princeton Economics, explaining the part that Pi had played in his calculations. The model was imperfect. It failed, among other things, to foresee its developer's demise. In September 1999, Armstrong was charged with defrauding Japanese investors of nearly $1 billion. It was a strange and convoluted case, and his view of it, unsurprisingly, does not square with the government's. The upshot, though, is that he has now spent more than 9 years in jail, a Pi cycle, and then some. He no longer talks to central bankers or has access to his computer models, and apparently no one else does either. The methodology has to remain a secret until I am free at last, he wrote recently. But the cycles spin on. Here's the thing that gets me. What makes the hair on the back of my neck stand up? A former employee of Armstrong's, who now manages a hedge fund, has half whispered to me over the phone not long ago. So December 89 is the high of the Nikkei, which he called. Go back 8.6 years. May 10th, 1981, he ticked off some milestones. Mitterrand, Volcker, and then back another 8.6, and then another. There's a high to high to high rhythm here. He said that he had counted forward from July 20th, 1998 to the next major date, February 23rd, 2007. I thought, this could be important. February 23rd, 2007 quietly came and went, and the Armstrong skeptics sneered. But it turned out that that day had seen some of the tightest credit spreads ever. That is the easiest credit. Home prices, meanwhile, had begun a sharp decline. It was the peak of the easy money bubble, the edge of the precipice, the lip of the recession. That this became clear only in retrospect says as much about the perils of prediction as it does about a propensity to see, as the past recedes, patterns and narratives that flatter out our particular angle on the world. I love the New Yorker. Stanley probably still reads the New Yorker. They write really well. But I love the way they paint the picture here. I mean, this is what I got to tell you guys. You got to go and study cycles. Cycles are so important. And the foundation of the study of cycles, go to their website. It's cycles.org. Okay, here's the link. And you can also go to their YouTube channel and watch their YouTube. I played some here already, and I'll keep playing some more. So that's their YouTubes. So go there, watch this stuff. And I told you, and Bitcoin is a great example of cycles because it's designed from the ground up to match a certain cycle. It has a halving cycle, which is aligned to the presidential cycle of the United States. Everything's aligned. And someone did that on purpose, and that's why you see Bitcoin going up now, and then it's going to go down. It has a cycle, a rhythm. And if you are in tune with it, you can trade it. So anyway, let's continue with this article. This is still long. We haven't gotten to the good stuff yet. Still, something turned, and you can feel it, the hedge fund manager said, but you couldn't find much of anything about it in the papers. There are two modes of financial market analysis. The first is fundamental analysis. You evaluate, say, a company or a security and draw conclusions about its prospects and assign it the value and the price you think suits it best. Pants Inc. looks good because it has great earnings and cash on hand, or because it has a charismatic CEO in good health, or because Europeans love buying pants and the euro is strong. This is what most civilians think that market professionals do. It's what the pros talk about in the papers or on TV. The other is technical analysis. It ignores all this noise. It disregards earnings and exchange rates and debt to equity. In its strictest form, it doesn't even care what a product a company sells. This is what I do. We're doing technical analysis here. Okay? Technicians don't believe that a stock has any intrinsic value. They focus instead on the market itself, on the action, the trading behavior of a security or an index. They study the charts for patterns of past performance that hint at future results. There are hundreds of templates ranging from the basic head and shoulders, a peak flanked by two smaller peaks, to the runic Bollinger Bands and the elastic method of determining a trading range, and the alligator from the trading website. When the jaw, the teeth, and the lips are closed or intertwined, it means the alligator is going to sleep or is asleep already. As it sleeps, it gets hungry and hungrier. The longer it will sleep, the hungrier it will wake up. And when the alligator eats, you should too, or something. All right, I'll tell you this. This is why technical analysis, when you just Google it, all the basic stuff, like what they just listed right there, is what you'll see. What I teach you right now on this channel is not any of that stuff. That stuff is like looking at the clouds or looking at the smoke and trying to figure out patterns. I see a face, I see a bear, I see something. No. Okay, we're not doing that. All right. Anyway, let's continue. When the alligator eats, you should too, or something. There are falling wedges, flags, pennants, scallops, saucers. One of the original technicians was Charles Dow, a co-founder of Dow Jones and the Wall Street Journal, Adherents later elaborate on his views to create Dow theory, which categorizes trends based on a variety of time periods. These days, many professional investors and traders rely at least a little bit on the technicals. Some hardly look at the fundamentals at all. Cycle theory is a kind of Gnostic offshoot of technical analysis. This is where, like, probably Momo will get interested. I said Gnostic, all right? The notion that things generally happen in cycles goes back thousands of years. Joseph's 7-year fat lean cycle, but in the West, the formal inquiry into economic cyclicality took hold in the mid-19th century. The British economist William Stanley Jevons correlated economic cycles to the sun, proposing that fluctuation in sunspot activity might affect crop outputs. Around the same time, a Frenchman named Clement Juglar, never heard of him, identified an economic cycle of 7 to 11 years. In 1920s, Nikolai Kondratiev, this guy's famous. You can look up Kondratiev cycles. Okay. So here, let me paste that. So you can Google that, Kondratiev cycles. Okay. Right there. A Soviet economist concluded that capitalism was inclined to half-century cycles of boom and bust and boom again, rather than, as Marx believed, a single inexorable march towards collapse. Wrong answer. Stalin had him imprisoned and executed. It was the Austrian economist Joseph Schumpeter, he of creative destruction, who called these cycles Kondratiev waves and popularized them in the West. In the Kondratiev waves and other commodity cited cycles, the kitchen 3 to 5 years and Kuznets 15 to 25 years. The time span is flexible. They are suggestions, not rules. Hardcore cyclists, on the other hand, often seek and find instances of periodicity as rigid and fixed as the law of physics, which is why hardcore cyclists are often dismissed as mystics or freaks. You know, one of the things you'll learn when you do so go to that website and look at the videos of the Foundation of Study Cycles. It's not enough to just to know the frequencies, all right? Right now, we're just talking about frequencies. Oh, 8.6 years, 10 years, 7 years, something like that. No. You also need the phase. Where are the alignments? And actually, the phase itself shifts over time. Okay, this is where the interesting thing comes in when you do really hardcore cycle analysis. But this article won't discuss that. It is easy to scoff at cycle theory. Its whiff of predestination chafes the scientific mind. Our culture's fundamental belief in causation and consequence, to say nothing of free will, does not easily accept the suggestion of helplessness or of some kind of as yet unidentified exogenous force. God may decide the outcome of football games and debilitating illnesses, but he does not intervene in matters of investing and finance. Okay, that's a very nice paragraph right there. Oh, yeah. Oh, Jewel, yeah, you know that. Yes, that's right. Oh, shit. Jewel, are you a mathematician too? So we got Jewel and Portia and all. Oh, shit. Yeah, there you go. That's right. That's right. Anyway, let's continue. I like that paragraph, though. That's a very nice written paragraph. Nicely written. And yet patterns exist, and we slowly discover them. Seasons, migrations, moons, the template is there, consciously and or unconsciously. Most people accept certain components of cycle theory. We seek and see patterns in things. It is the way our minds work, presumably for the purpose of survival. Few would deny that there is a business cycle, a fluctuation in the economic fortunes of a nation, or even a political cycle, an ebb and flow between mass conservative and liberal sentiment that reverberates in the markets. And it's common for us to think that some things are overdue: a change in the weather, a Masters championship, a comeuppance, or a lucky break. But most of us balk at the notion that any of these may be governed by some kind of deeper universal math. Armstrong, in his essay, Understanding the Real Economy, said, "I've spent a lot of time trying to comprehend how such a model can even work on a specific level. To a precise day, years and decades in advance, the only explanation is the subject matter is so intensely complex that there is indeed a hidden order within what would appear to be random chaos." All right. Let me skip ahead. I think let's go here. Skip ahead. Oh, they talk about Dewey. Yeah, Dewey's important to know. He's the founder of the Foundation of Study Cycles. Let's read this paragraph. One day I mentioned cycles to an acquaintance who used to work for Goldman Sachs, and he excitedly took down from his stacks a book he had purloined years ago from the library of the J. Aaron Research Department. J. Aaron being a commodities trading firm that Goldman bought in 1981 and that supplied Goldman with its current CEO, Lloyd Blankfein. Goldman Sachs has an interesting history. So you can go to the Wikipedia article on it, or you can find some other ones. But the way Goldman Sachs started, very interesting. It's kind of like, John, when he talks about, like, with Master Kim, about the gays, the little, like, co-ops, right? You just have these little communities of people trying to pull together money. That's what Goldman Sachs was for the Jewish community. They just, like, new immigrants come in, they need loans and stuff, so they pull together their resources. That's how Goldman Sachs started. So yeah, you can look up the history. Very interesting. It started like that. So anyway, it was Cycles Selected Writings, an anthology published in 1970 of the work of Edward R. Dewey, who was the chief economic analyst in the Department of Commerce in the early 30s under Herbert Hoover. To investigate the causes of the Great Depression, Dewey had talked to one economist after another. Each of them seemed to have a different explanation, which suggested to him that no one had a clue. Yeah, this is why economists, I never listen to them. You go on CNBC, you go on Bloomberg TV, you go to the newspaper, Wall Street Journal. You can hear 1,000 economists. All of them would have a different opinion. Tell me, which of these economists are actually billionaires or anything? Probably very few, if any. They're all guessing. Economics is so hard because it can't be a hard science. That's the problem with it. It tries to be a hard science, but when you're dealing with humans are irrational. They do strange things that make no sense. Like let's say, like, I drive to a gas station and I see, like, it's expensive compared to a gas station maybe 10 miles away, right? Some people would just willingly drive further out just to get that cheaper gas. When we figure out, yeah, you just spent, like, how much gas just to drive to that 10-mile station out, and you'll figure out, like, hey, you didn't save anything, honestly. You could just stay there. Humans have emotion. Humans are not rational. They don't think like you think they should think. And when you take that into account, it's very hard, right? Very hard to quantify it, model that. That's why economics, tough. You can't turn it into a science in that sense when you're dealing with humans here. Anyway, so to investigate the cause of depression, blah, 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 but he lingered, over the work of one economist, Chaplain Hoskins, who was interested in the behavioristic approach. Hoskins, Dewey wrote, discovered that there was a tendency for certain business behaviors to repeat at fairly regular intervals. The reasons for these regularities were unknown, but the patterns were too regular to be easily the result of chance. They therefore had forecasting value. When FDR took over, Dewey left the Commerce Department and soon found that these cycles were everywhere. In animal abundance, sunspot numbers, disease, weather, and many other things. The purloined Dewey book, nearly 800 pages long, contains one delightful data set after another. The 16 2/3 year cycle in Arizona tree rings, AD 900 to 1939. The 4-year cycle in the consumption of cheese, 1867 to 1953. Dewey produced sine waves depicting fluctuations in the prices of malleable iron pipe fittings and in postal receipts in Milwaukee. But it's the ones that overlap that widen the eyes. For example, starting in 1735, the Hudson Bays Company kept track of the number of lynx pelts collected in Canada each year. The number rose and fell precipitously in a distinct cycle of 9.6 years. Oh man, Hudson Bay is like a really ancient company. Yeah, if you want to look at the Dutch East India Company, the British East India Company, look at all the data from there. That's like crazy stuff, man. You look at trade and things going around the world, it's amazing. And one of these days I gotta play this old video where I'll show you where the Chinese demand for silver funded the Spanish empire, right? So the Spanish would sell their Mexican silver or Peruvian silver all the way to China, get the funds so that they could do all the little wars in Europe, right? So they went into a Catholic frenzy. And it's only because of the Chinese demand for silver that they could do that, So if you look at the way humans work, the cycles and stuff like that, it's amazing. It's amazing. And it affects everyone. Everyone. I think people only think that only recently we have globalization, but we had globalization for everything. Everything. And we didn't have planes back then, but people traveled and people did trade. So everything affected everything, and you're gonna see cycles everywhere. Probably you're gonna go schizophrenic if you keep seeing this stuff. Yeah. I gotta find that video, Jewel. It was a nice documentary. Man, what is it? Oh man, now I gotta look it up again. I'm sure I can find it. Silver, China. Oh my god. Yeah, with the opium wars and all that. I'm sure I can find it again. Yeah, I think it might be this one. I'll have to see. I definitely watched it. I don't know if I downloaded it. I download this. Oh man, I'm sure you can just look up silver, China, Spain, something like that. Spain, silver, China. I mean, there's so many documentaries. People love making documentaries. That's easy content. But the one I watched was really good. Man, I gotta find that. Shoot. Yeah, okay. I gotta put that on my list of things to find again. Hopefully I downloaded it at least. Oh, shoot. Anyway, it was fun. Okay, let's see. Blah, blah, blah. Okay, as it happened, this cycle was synchronous not only with the variable abundance of indigenous fauna such as snowshoe rabbits and Atlantic salmon, but also with the cycle of seemingly unrelated phenomena such as heart disease rates in New England and bug populations in Illinois. Dewey reasoned that all this had to be either a coincidence or the work, as he put it, of something out there. He favored the latter. All right. Yeah, this is crazy. I mean, this article is so long, but there's so many good things in it. Oh man. Oh, this paragraph's crazy. Here we go. Let me read this one. The array of cyclomaniacs, an old Dewey term, pattern seekers and market timers are like rival Christian sects, prone to doctrinal disputes, petty jealousies, and exclusive claims on divine revelation. They tend to think that their patented system is best and trumpet a dozen peerless predictions. They cover a wide spectrum from the omnivorous technicians to the market astrologists who look to the stars. Arch Crawford, a well-known forecaster, has made a series of startlingly accurate predictions over the years. On the basis of planetary and astrological alignments, he says that he was up 106% last year. The summer of 2010 will be devastating, he told me. We'll have the worst stuff in the sky in 200 years we've checked. Indeed, at the end of July, Mars and Saturn will be conjunct and in opposition of Uranus, and all three will be square to Pluto. Crawford quoted a line that he attributed to JP Morgan. Millionaires don't have astrologers, but billionaires do. All right, that's a famous one. That's a famous quote right there. Okay. So let's go down to this. Fibonacci. Okay, I think you guys know a lot about this Fibonacci stuff. Quite famous. And this is where it'll lead into DeMark. Okay, so I'll mention him a bit. Then there's Fibonacci. It is widely believed, but variably disputed, that such natural phenomenon as the spirals in anomalous shells, hurricanes and galaxies, the branching of tree limbs, leaf veins, skeletal and circulatory systems, and the distribution of flower petals and brain waves conform to something called the golden ratio, or phi. There we go. All right. And it's what Jewel mentioned. Represented by the irrational number 1.618 in a golden spiral, for example, each successive outer curve might be 1.618 times as far away from the one inside it as the last. In the early 20th century, as fans of the Da Vinci Code and the band Tool know, Leonardo Fibonacci, a Pisan mathematician, unearthed a series of numbers in which each successive number is the sum of the previous two: 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, etc. It has many elegant properties. One is that every fifth number, and only every fifth number, is divisible by 5. Another is that the ratio between each number and the one before it converges on phi. Interest in phi and the Fibonacci sequence, as financial cipher goes back many decades. Dewey wrote a report on Fibonacci, non-symmetrical cycles in cycles, the Foundation's magazine in 1966. So if you go on to the Foundation of the Study of Cycles, all right, go to their website. You know, if you're a member, you can go and read all that stuff. That stuff is all there for you to read. Yeah, I think you got to be a member to get the old issues of this magazine. The idea is that, say, the S&P 500 in an up market will consist of a 5-legged ascent and 3 progressively rising peaks and 2 dips in between, followed by 3-legged descent interrupted by 1 lower peak, 5 up, 3 down. You too can make billions. Hey, guess what? Okay, I'll stop here. So what did I talk about over the weekend? Let's see. I think I talked about Bitcoin doing that thing too, right? So let's see if I can find it. I gotta get the picture. Gotta find the picture here. Okay. Yeah, I'll show it to you guys again. Right here. 5 up, 3 down. 5 up, 3 down. In cycles of 200 days, roughly. Interesting, isn't it? Very familiar. These things repeat. Is this a coincidence? Is this providence? Do you believe in free will, or you'll believe in fate? This is a question I gotta ask people. That's always a debate on YouTube, isn't it? They love freaking like doing that debate. Free will. Is there free will? Such a thing as free will? Blah blah blah. Yeah. All right, whatever. Let me go get back to the article. We gotta go through this quickly. Because we haven't even got the good stuff yet. Like I gotta get down to the good stuff. Okay, Tom DeMark, a market timing analyst. I mentioned Tom DeMark before. There's DeMark counts. DeMark counts. All right, and we'll discuss later. Has worked with hedge fund titans as Stephen Cohen, John Burbank, and Paul Tudor Jones. Paul Tudor Jones. I'm gonna play a video with him. This video is hard to find. Documentary is hard to find. He has over 40 years devised a Fibonacci-based system to monitor and time the exhaustion of trends, that is, to figure out at exactly what point a market or anything really, it worked, he says, for the population of geese on Horicon Marsh in Wisconsin, reverse directions. So you can look up DeMark indicators, DeMark counts. There's a 9 count. And there's also a 13 count. And there's a D wave. I haven't covered it too much. It's really esoteric. All right. So I don't want to do that right now. But keep that in mind. Eventually, we'll have to do that. DeMark's initiation into the fellowship of Fibonacci was typically circuitous. The discipline attracts a certain kind. After enduring a video called History's Hidden Engine, which featured one pale fellow after another talking about fractals. Fractals. I've said fractals. How many times I've mentioned fractals? My wife turned to me and said, "There ain't a lot of women, are there?" Okay, I'll tell you this. Technical analysis and all this stuff, this is astrology for men. All right? Men love this type of crap. So when you look at technical analysis and they'll do stock market stuff, men love it, right? Just like women love astrology, mainly. Men love it. This is their astrology, is doing this type of work here. In 1971, DeMark, then a gopher at a money management fund in Milwaukee, was happily perusing an article published by a bank credit analyst that mentioned research on wave theory and Fibonacci conducted in the 1940s by an accountant named Ralph Nelson Elliott. Okay. Elliott was the author of a book called Nature's Law, The Secret of the Universe. Fascinated, DeMark called bank credit analyst offices. The article's author, DeMark said, suggested he call a traveling tax judge in Canada named Jack Frost. Oh, Lord, I got tax judge. All right. Oh, who in turn suggested that DeMark call 2 doctors in Florida, the first of whom agreed to come up to Wisconsin to present some data on Fibonacci and the markets to DeMark and his bosses on a Friday night. DeMark went to the Milwaukee airport to fetch him, and after wandering around the terminal for a while, came across a man with a long white beard who pointed at DeMark and said, "You know how I know you're Tom DeMark? You're walking in Fibonacci angles." All right. This story is getting crazy. The other doctor had told DeMark on the phone, "I've been married 5 times. I have 8 children. I take a vacation every 13 days. At the meeting, the doctor took out a folder with graphs depicting the Dow Jones Industrial Average back to the inception of its precursor in 1884. It embarrassed me, DeMark recalled recently. I thought I was going to lose my job. He did not. The Fibonacci obsession spooked him, but infected him all the same because he began to see the numbers everywhere, too. Over the next decade, DeMark spent thousands of hours poring over old stock charts with a magnifying glass and a calculator, identifying patterns." Okay. This is really important here. I'm going to skip through this. I mean, Elliott Wave is pretty important to talk about. Okay. Okay, I can't skip through it. Never mind. We're almost there. We're almost to the point where the article gets good. All right, I got to talk about Elliott. Ralph Nelson Elliott had also captured the imagination of a young technical analyst at Merrill Lynch named Robert Precher. Merrill in the 70s was a hotbed of technical research. Pritchard found Eliot's original works in the New York Public Library and republished them, turning the Elliott wave principle, long forgotten, into a fashionable conveyance for Fibonacci on Wall Street. Elliott maintained that the arrangements of the market's zigs and zags were repetitious, predictable, and fractal, like the crenellations of ferns and sea. Man, all right, New York Times, can you not use these big words that come out of nowhere? All right. Self-similar at any scale, whether they depict 3 hours of trading or 3 decades. The hard part is figuring out where you are in which wave. Stare at a chart long enough and it will start to look like whatever you want it to, except easy money. Pritchard doesn't manage money, he sells his analysis to people who do. What many of these guys have in common is an underwhelming net worth and a commensurate declaration that they aren't in it just for the money. Is it possible, considering the mind's capacity for converting complexity into some kind of manageable order, that we may be imposing these patterns on randomness? All right, that's a good question. I think it's a shallow question, Pritchard said. Think of the stars, the zodiac. The ancients didn't say there's a bear. They needed the stars for the purposes of navigation, and so came up with names for recognizable arrangements of them. This is where we're going to end me reading this article. In 1987, a documentary called Trader about the then little known fund manager Paul Tudor Jones appeared on PBS. After it aired, Jones reportedly had it taken out of circulation, buying up any copies he came across. Over the summer, sections of it turned up on YouTube, and you could see Jones and his baby-faced partner Peter Borish applying Elliott wave theory to their comparison of the movements of late 1986 with those of 1928. It helped them call the 1987 crash, and Jones became a billionaire. Jones won't talk about it now, but Boris, the chief executive these days of a firm called Computing Trading Corporation, doesn't disavow any of it. We met one weekday morning in Central Park and talked long enough to observe joggers and dog walkers on their way both in and out of the park at plottable intervals. The amplitude suggested high unemployment. If your goal is to do research and try to extract money from the markets, you should look at all ideas, he told me. Whatever works. He went on. A lot of these guys are freaks, and I don't mean that in a bad way. They spend their entire lives searching for the Rosetta Stone, so at the end of their lives, maybe they can make money. All right. I'm going to end it there for reading this article. Okay. And I'm going to play a little bit of that documentary right now. And you can get a link to the documentary in the description. Okay. Because I'm going to play this. This is really interesting, I think, for you guys to listen to.
Yes, there will be some type of a decline, without a question, in the next 10 to 20 months, and it will be earth-shaking, it will be saber-rattling, and it'll have Wall Street in a tizzy, and it will create headlines that will be that will dwarf anything that's happened at this point in time. I'm about there, look. I wonder where we're going to take off. 8 minutes to go, and I'm getting ready to give them little drums along the Mohawk. Do a little tom-tomming on the market here on the end. Offer 3,070!
Offer 3,070. Offer 3,070?
Yeah.
Up into the phone.
Hey, listen, Benny, don't offer that. Sell 540 market. Sell 540.
540 market. Sell 540 market. 540 market?
Yeah, March, go! Well, anyway, the whole point is I risk 10 cents, right?
Are you risking 10 cents to make $8? I'd like to, that's not a bad trade. Right?
Yeah. Oh, God, and it would work so perfect for the stock market and bond market if this were to happen. And the stock market would explode. I mean, the Dow 2,500 wouldn't even be the first stopping point today.
I mean, I've heard stories about this guy. He wakes up at like 4 o'clock in the morning and trades like gold in Hong Kong and all sorts of places. I mean, if I woke up at 4 o'clock in the morning, my wife would say, you know, get back to bed. This is ridiculous.
Yeah.
63 and 73 and 800 contract.
I'll tell you what I'll do. You own 540. You own 540. Only 540.
540, what are you doing?
I'm selling D-marks. You own 540.
He really loves it, and it involves sort of the use of all his energy, all his power, all his knowledge and everything. And he puts it together into one incredible life.
If I make the mark that I want to make, I'll stop. I'll retire, hopefully, a champion.
Paul Tudor Jones is a futures trader. He speculates on the future value of almost anything. It's been called an art, a science, a gambling game. It's a high-risk game for high rewards in an arena that is increasingly under scrutiny. Recent scandals have brought the Wall Street community into the glare of public and media attention, and the regulatory agencies are questioning the very existence of a certain kind of trading, stock index futures, at which Paul Jones has recently been one of the most successful players in America. It is March 1987, the third month of one of the most dramatic rises in the history of the stock market, and Paul Jones is taking a holiday. Well, sort of a holiday.
When I originally decided to come here, it was going to be vacation, get away from everything. And then, as it turned out, a number of the clients that I have are here in Europe, and most of them here in Gstaad, as it turns out. So I've done an enormous amount of business. I've been in Paris, I've been in Geneva. So I kind of combine business with pleasure. I wish it'd been more pleasure, but I still wouldn't trade for anything in the world. The most, you know, I always think of, I mean, if life ever ceased to be an educational experience, then I probably wouldn't get out of bed.
This morning, Paul got out of bed at the Palace, one of the most elegant hotels in the world.
The lifestyle here in Gstaad is incredible because the people that I've met here and the people that I deal with, most of them are my clients. They pay me to allow them to enjoy this lifestyle, which is wonderful because I enjoy working. I had a friend that I played backgammon with in college all the time. We were having barbecued ribs for lunch during my second semester senior year in college. And he said, and I've always liked backgammon, chess, those type of games. And he said, if you think those are fun, if you really enjoy that type of stimulation, then he said, I'll show you a game that is the most exciting, the most challenging of all.
Paul's company, Tudor Investment Corporation, manages other people's money. The firm has about 300 clients and has been rated top performer in its field for 2 consecutive years. Paul is the oldest one in the office. He's 32. His chief economist, statistician, and right-hand man, Peter Burish, is 27.
We're making history today. The market.
Futures trading is a young game.
Just everyone jumped in. You know, there's a way. You know how there's a way to check.
As firms go, Tudor is small. It has only 22 employees and manages $125 million, which isn't so much on Wall Street. But the team, for the time being anyway, likes it that way. They see their firm as a small, fast boat on a large, rough sea.
What I love about it is I'm doing my work, I'm doing my analysis, and I'm graded instantly. And through the harshest teacher in the world, there's no curve. You know, I can't say that, boy, I was out late last night and everybody else in the class was at a pep rally for the football game and I only got a 70, but that was the highest in the class, so I still get an A. It doesn't work that way in the market. It's an intellectual challenge, and that's what makes it so exciting. Every day is something new, and every day is providing new information. Every day, every hour.
Paul buys and sells futures in cotton, oil, dollars, Deutschmarks, bonds, precious metals, anything he thinks can turn a profit. Every rumor, every news item can be a warning or an opportunity. For example, this morning, the wires say OPEC is on the verge of a new agreement.
OPEC has basically come to an agreement whereby they're going to have a 7% production cut. And my whole feeling is that anytime that you try to get 13 people to agree to anything and I have a chance to take a position on it, well, they're going to have to, you know, wild horses couldn't keep me from betting against them succeeding in that. I'm selling the equivalent of about 4 tankers on the opening. You've heard nothing else on OPEC?
No.
I got you.
Thank you, Paul.
Yeah. What do you think of it, JJ? Is this a spot to nail it? I'd rather sell it down, though, than sell it
Betting
here.
that the agreement won't hold, Paul is selling oil futures as fast as he can, hoping that the other traders won't see what he's up to. Speed is everything.
Is 40 bid and a half? Offer 1,000. Offer 1,500 at 40. Offer 1,500 and a half. Show the size. Ask him how much he sold. Give me a number. Tell him more behind it. Do it. Do it. Do it. There's more behind it.
More behind it.
I can feel it. They're gonna get it. I'm gonna get it. Iraq just said something. What does Iraq say? That's great. That's great. They have an agreement between 13 people, but 2 of them said they won't agree, which happen to be 2 of the 5 biggest producers in the world. That was tough to figure out, wasn't it?
Paul is on the phone to an oil trader who's saying somebody's been selling a lot of oil, but he doesn't know who.
That was my buddy at probably, again, the second or third largest crude trading firm. And his guy said, man, those guys, they sold the hell out of it. And the people that he worked with don't know that it was, which is great. That's even better. I hope they think it's some wild as shit Arab who knows the whole agreement's getting ready to fall apart.
Even though Paul trades in every kind of commodity, his specialty is stock index futures, which are traded in pits at various commodity exchanges like the Chicago Mercantile Exchange, the MERC, or the New York Futures Exchange, the NYFE. These people are betting not on a company or an industry, but on the future direction of the entire economy. And this week, just before Thanksgiving 1986, the big news is not good. The Iran-Contra affair has just broken, the insider trading scandal is heating up, and the market has been going nowhere.
85.90.
Okay.
Is it a fast market?
85.90. There's nothing here.
In spite of the bad news, Paul and Peter are convinced that at any moment the market is going to soar.
With a half an hour to go, because not only will we be selling, so will everybody else in the street. Which means I want to get Paul. Paul.
Yeah, man.
Do it again. Another 300. Sell them. 3 minutes. 3 minutes.
Paul has bet a lot of money that the market is about to go up, but nothing is happening. If he's bet wrong, he's in trouble.
The market goes down so much more faster than it goes up. It's incredible, right? It can take out 2 weeks of work in 3 hours. In fact, it took out 6 months of work in 1 day in September.
We're going to get a big move one way or the other. And it's just right now trying to gauge which way that move's going to be. Everyone right now has to be negative walking in the morning, looking at the newspaper, looking at the fact that the bonds are down, and yet this thing is maintaining an enormous premium to spot. All that stuff is sitting there looking at us every morning in the headlines, and yet the market won't go down. It's telling a different story than the headlines are. What is happening again is that the market continues to build energy, and every time you see these incredibly sharp downturns, all that's doing is, or to me, all that is a signal of the fact that people are absolutely skeptical, negative, and to a certain extent frightened through here, and yet the market won't break. It is screaming to me that it wants to go higher.
At times like this, what gives these two confidence is a theory that says the stock market moves in cycles, in patterns. And Paul and Peter subscribe to the Elliott wave theory, which says to them that what happened 49 years ago, in the late 1920s, is happening again, now.
If the market is a reflection of people's behavior and people behave similarly in similar circumstances, then history of market prices may give us an indication of what may happen in the near future. Well, the last great bull market really was the 1920s. And we looked back and did a statistical analysis on the 1920s through today, punching in literally thousands of Dow high, low, and closes to run correlations between what happened in 1925 to 1928 to what happened between 1982 and where we were in 1986. Well, that correlation turned out to be over 90%. In fact, since I've run that correlation, the correlation has gone up from about 90.7% to close to 92.2%. And as you
Which
can
one
see,
which one is the 20s?
the 20s is the blue and the red is the 80s.
So what day back in the 20s are we at right now, approximately?
We're like in early August 1928.
And so let's see, if my memory serves me correctly, then we've got another 40% in the down the upside.
Correct.
So we're talking
And
about
about another year, a little over a year, up moving the Dow.
and then it looks like there might be some storm clouds in the horizon.
To say the least.
The correlations here are phenomenal. That's incredible. What are the chances of taking any 5-year period in the stock market and getting that kind of correlation? What would you guesstimate off the top of your head?
I mean, it's got to be astronomical. You're talking 1,000 observations. I don't know, 1 in 1,000. It's really pretty scary. You know, if it looks like a duck and it acts like a duck and it sounds like a duck, it's probably not a chicken. And that's what's scaring me about the activity in the stock market right now.
Some analysts disagree, but Paul Jones and Peter Burish are among those who think there's a crash coming, and a big one.
You're probably talking about something with incredible fireworks, with unbelievable and unprecedented volatility, and with moves that will leave people gasping. It's going to be total rock and roll.
The market should continue to rally into the first quarter of 1988. A rough projection would be somewhere around 3,200 on the Dow. And then in March, April of 1988, there's weakness, and at some point shortly thereafter, and if you're going to hold me to a date, let's say the end of March 1988, the market then drops sharply and retraces, 50% of this bull move from 770 to 3,200 in a matter of a couple of months.
The last guy that buys a share of stock when the Dow's at 3,000 or whatever number it is, he's buying it because, in fact, he thinks it's going to 6,000 because it's been reinforced in his mind over the past however number of months, years, or decades that the stocks can't go down.
In one sentence, buy low and sell high. That means buying now, riding it out till the market goes to about 3,200. Don't wait for top tick. That's 1988. Severe drop, a little rebound. By 1991, the market is going to be under 500 on the Dow.
The debt gets to the bottom of the accumulation, and then the repayment of debt basically drives every economic cycle that there is. And right now, we have probably explored the envelope with regard to mortgaging our future earnings. The next part of this cycle will be the repayment of what we've enjoyed now for the past 4 or 5 years. I mean, again, we're in the largest post-war business expansion cycle in history.
I'm concerned. And knock on wood, if we're successful here and the play comes about and we make a lot of money, I want to go work for the Treasury or work for the State Department or work for the Fed to help out of what I consider will be dire economic consequences.
All right. Okay. So I think you got a good idea about that. I mean, their predictions wasn't too far off. So the Black Monday was 1987. Okay. So you look at the Wikipedia article about it. Black Monday. If you don't remember that, let's put that in there. And he's talking about Elliott waves and the cycles and things like that. all that stuff. Yes. And that's why they wanted to get rid of this documentary. I guess that was too much information for the masses, you know. You don't want them to be looking into cycles. It's kind of like the edge you get. So, yeah, let's look at Black Friday here. There's a Wikipedia article. Black Monday, Black Monday. Black Monday. So, did the S&P get to 3,000 or whatever? Nah, it got close enough to it. Close enough. And then it just crashed. This was also known as Black Tuesday in some parts of the world due to time zone difference. Okay, Black Monday was the global, severe, and largely unexpected stock market crash on Monday, October 19th, 1987. Worldwide losses were estimated at $1.71 trillion. The severity of the crash sparked fears of extended economic instability or even a reprise of the Great Depression. So, yeah. We recovered from that. I think a lot of the issues with Black Monday was because there's over speculation, introduction of computer trading. So computers were just on the rise at that time. Also, options market was starting to boom at that point too. You have to remember, options was a new thing at that era as well. So people are so used to options now that they were definitely a new thing in the 80s. So all these things were part of that thing. And yeah, you can look up. So there were plenty of people who were predicting a crash some at that time, and they were using cycles. Let me play back the part here.
To build energy, and every time you see these incredibly sharp downturns, all
yeah,
that's
he talks
doing
about
is
energy.
people
So let's go back again.
Paul has bet a lot of money that the market is about to go up, but nothing is happening. If he's bet wrong, he's in trouble.
The market goes down so much more faster than it goes up. It's incredible, right? It can take out 2 weeks of work in 3 hours. In fact, it took out 6 months of work in 1 day in September.
We're going to get a big move one way or the other. And it's just right now trying to gauge which way that move's going to be. Everyone right now has to be negative walking in the morning, looking at the newspaper, looking at the fact that the bonds are down, and yet this thing is maintaining an enormous premium to spot. All that stuff is sitting there looking at us every morning in the headlines, and yet the market won't go down. It's telling a different story than the headlines are. What is happening again is that the market continues to build energy, and every time you see these incredibly sharp downturns, all that's doing is, or to me, all that is a signal of the fact that people are absolutely skeptical, negative, and to a certain extent frightened through here, and yet the market won't break. It is screaming to me that it wants to go higher.
At times like this, what gives these two confidence is a theory that says the stock market moves in cycles, in patterns. And Paul and Peter subscribe to the Elliott wave theory, which says to them that what happened 49 years ago, in the late 1920s, is happening again, now.
If the market is a reflection of people's behavior and people behave similarly in similar circumstances, then history of market prices may give us an indication of what may happen in the near future. Well, the last great bull market really was the 1920s.
That's it. Human behavior does not change. All right. So if you can get the cycles, you can find these things out. That's what we want to do. Okay. I gotta continue on with the little video I played yesterday with Samantha LeDuc. So let's continue on this one. Oh, I gotta get the timestamp though. Which one was it? I gotta find this. All right, let me.
All right. Well, greetings, everyone.
It was around here,
The
probably.
defensive staple.
No, it wasn't here.
It doesn't mean that all
No.
the dollar, but this recalibration is actually, again, good for U.S. exporters, not importers. Notice you'll see kind of cars. So Toyota German, BMW, Mercedes. They're going to have, more tariffs if they don't if they don't reciprocate with Trump. So likely Germany and Japan will reciprocate with Trump, but China, of course, has reason to worry, is basically it. So in this particular kind of focus, I'm getting really into some of the macro stuff, but there are micro considerations like the dollar. We haven't even talked about yields. I have talked about oil. I've talked about the Maha trade. This is where I'm really kind of trying to figure it out, which is right here, right? So I know, for example, that, that China is right to be nervous, right? I get this. They have not needed to unleash fiscal stimulus, and they don't plan to until they can finalize negotiations with Trump. And Trump isn't even in the White House yet. But they have reason to be nervous because of this pending dollar devaluation to balance trade, de-dollarization, which is going to help the U.S. debt problem. This will make the U.S. dollar fall relative to CNH, and that will hurt China exporters. They have a reason to worry. So I don't think this is going to go away. I think Trump's going to negotiate it. He's going to have tariffs. They're going to devalue. But big picture, they know it's going to be harder. And so the end result is that the exporters to the U.S. will be hurt. U.S. exporters to the rest of the world will be helped. So think about those companies that actually derive a lot of revenue in dollars, right? I mean, that derive a lot of revenue abroad that convert into dollars. And those manufacturers are going to be also more incentivized to bring jobs back to the U.S., which is the hope and goal, which will drive wages and prices higher in the next few years. It won't happen right away. And those who are expert in this space of actually being CFOs at large companies have told me that in the first year, consumers they make sure the consumer doesn't feel it so much. In the second year, that's when they raise it. So this 2025 period may not be such a big hit. However, it depends who really is going to be in the seat of trade policy. Right now, it's suggested that this very, very strong China hawk, Robert Litzinger, I can't pronounce his last name either, he wants to be completely decoupled from China. I'm talking economically, technologically. So that's not going to be priced in yet. And then, of course, the Treasury Secretary will set monetary policy with the Fed, but will have to identify, again, with tariffs and with fiscal, how it's all going to come together to, how to do their refunding of the fiscal, how to work with the Fed, who right now is Powell. It says he's not going to leave until May of 2026. But the point is, there's going to be a lot of potential volatility moving forward with these policies, because there, at some point, both Chinese and U.S. investors are going to realize this Trump train could derail the gravy train, which is triggering potential exodus or, repatriation of foreign money out of U.S. stocks, bonds, and dollars, even if that's the goal. Okay, so even if that's the goal. So that's basically it in a big picture. It would be good for I think bonds as well. The other kind of Trump trade that I've talked about is that it could be very beneficial for peace. Now I know he's a big China hawk and Iran hawk. Iran war, whatever. But the point is, for the most part, we could get a situation where, and this is not at all popular and not political, but it is a fact that if we get into a situation where Trump says to Putin, right, and they keep talking, even Putin today says he's not going to negotiate right now with anyone but Trump. If Trump gives him what he wants, which is pieces of Ukraine, right, then there will be at least peace that should help Europe, that should help U.S. bonds. It's not here yet. It's the opposite right now. They're escalating. And, Biden giving approval for long-range missiles and Russia retaliating. It's not a good scene right now, 59 days before inauguration. But when and if we could get this peace between Russia and Ukraine, we could actually have Trump remove the sanctions. Does anyone remember where the US shook the world and seized Russian assets, and they've used the interest off those assets to fund the Ukraine war? That's a big no-no for US Treasury value. So we could get that reversed, which would also help bonds. So if they remove the sanctions on Russia, that would be very beneficial for US Treasuries. That's basically it in a nutshell. So that's another kind of the peace trade that is the macro trade to tactically think about. If, however, they don't do these things that I've talked about, right? This is still my baseline bet, which is, right, this fiscal restructuring. And I know everyone really doesn't believe it, but I don't think you can dismiss Vivek and Musk too easily. But I do want you to kind of consider this. If they are able to do some fiscal restructuring, it's good for bonds, for US bonds. If Trump does come in with his peace trade, right, of removing sanctions on Russia and or returning seized assets, that's good for bonds. If they continue to stealth devalue the dollar to make up for high tariffs, that's good for US exporters who derive revenue abroad and convert back to dollars. And in time, I don't know if they're going to have enough time, it would be good for an industrial kind of renaissance, bring manufacturers and jobs back. It's a lot. All right, so now you're kind of thinking, okay, you talked about the dollar, you know, the Treasury Secretary and rates will matter a lot, by the way, because right now they have two that are pro rates, higher interest rates, and we have two that are lower interest rates, and none of the four are qualified to, in my opinion, really bring about an industrial renaissance. Three of them are, you know, private equity, hedge fund guys. One's a senator, the other one is a former Fed head, but none of them have any experience actually in manufacturing and bringing jobs back. Nothing. So it's a little frustrating. Anyway, these are some of the other kind of overarching macro and then some micro trades. The cost of labor, yes, it can rise on the reversal of immigration policies, but like I just mentioned, if the government efficiency does its job of removing a whole bunch of chair warmers, then on the aggregate, we're going to have not a transition of government workers to do all the work that the immigrants are doing, right? The illegal immigrants are doing. No, that's different jobs. On the aggregate, it will spike unemployment higher. So it isn't, there is not a one for one here. You just can't get rid of 4 million illegal immigrants and also fire 4 million bureaucrats and then call it a day. They're not the same jobs. It will spike unemployment, and that's going to be a disinflation trigger that's going to bring rates down. That's, again, an if-then. So, and very, very likely they don't do it all at once, but then who knows, right? They're talking a big game. Energy, the cost of energy. I've shown to you that I think actually oil falls, and I've been an oil bear since about April, May timeframe. Completely turned, by the way. Became an oil bear in April, May, long before Trump came in and said, I want to reduce energy costs. I actually think that could help as a little bit of an economic stimulus, but it's going to confuse the macro folks that are used to having yields fall with oil and vice versa. That correlation, I think, is done. So unless we can get, you know, this Department of Government Efficiency to really bring about some fiscal restructuring, then yields should also fall. Otherwise, forget about it. We're going to have a steady appetite of strong to higher yields, even if oil falls, okay? And the cost of financing this huge deficit, if they don't spend, it of course falls, and the collateral value of bonds rises, but it especially rises from fiscal restructuring. So I can't underemphasize that fiscal restructuring is key. And that's why I'm so focused on the US Treasury Secretary. By the way, all four of the candidates, in my opinion, are not great. So I'm disappointed greatly about that, but I can't do anything about it. Really. So cost of devaluing the dollar, however, which is their goal, It means foreign demand of dollars will weaken, but it also means that we have at risk of some of these assets being sold, like I just showed you in Texas, which was, a few hours ago. But it also means US assets. It's at risk. So, how long will it take before US exporters can really benefit and rebuild the, industry? This is all that we're trying to figure out, and it's only been a week or two, and lots of moving parts and a cabinet that's not even full. Anyway, tax cuts, most are talking about this, but remember, they do serve as economic stimulus, mostly for corporations. But if they're, and again, I don't know if IRS is going to be eliminated. Wouldn't that be something? We, by the way, functioned as a nation for many years with no IRS, with no significant taxes. It was tariffs. But for the most part, I'm not advocating that. I'm just saying we'll see if IRS gets shut down. But tax cuts do serve as an economic stimulus, but that means less government tax receipts. See how everything is like the yin and the yang? You got to balance all this. It's not just one and done. This is complex, man. This is like really very, 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 very hard to predict. So I want you to just kind of think about all of these different factors, because there are many players that he's trying to bring together to, I think, affect this as three overarching goals, right? But all of this other stuff we're trying to figure out along the way, and what could spike unemployment, what could spike yields moving higher, what could, what we're looking at is what's going to be a headwind for this lovely market rally that we have enjoyed, where the NASDAQ 100 is literally up as of today, 96% from January 2023 low, right? We're almost at 100%. Really. I mean, we had it's not even a bubble yet. So the point is, if we can get some continued economic stability, wage inflation, and productivity rise with inflation, we'll be fine. If inflation spikes up like it did in 20 and 21, and wage inflation couldn't keep up, we're not fine, right? So it's all about this balancing act. Right now, wage inflation with productivity is keeping up with the inflation. It's okay. We're in this kind of like Goldilocks period. Wage inflation has not spiraled higher. It also hasn't collapsed. So we don't have a recession risk front and center. But the point is, it's always, this stuff is always against the backdrop of the dollar. Its value relative to FX, which is foreign currency, relative to commodities. So right now, the dollar is still looking very much like the number one thing that they need to control. And through the dollar, yields will follow. If they can get control of fiscal, which they say they want to, then they'll have a much better shot at accomplishing this industrial renaissance. Otherwise, all bets are off. They will continue to do what they're doing right now, which is, repress rates, issue short duration T-bills versus longer duration notes and bonds, which keeps the whole gravy train working through stealth QE, monetary games, and financialization of assets where there's still tons of money running into things like MSTR and Bitcoin. But this will change if these three goals are really the goals and they stick that, agenda. Otherwise, we're going to be at this risk of they devalue the dollar too quickly, and that basically gets all the animal spirits getting very, very excited. And this everything bubble just grows larger without the fiscal restructuring, without bringing manufacturing and jobs home. So that's really why it matters. And I would not, honestly, you got a really tough bet right now because I think the market is obviously fine. I've written about this, right? Like this is not something I haven't thought about a tremendous amount and discussed with clients in our Slack workspace, etc. We got lots of reasons to stay, bullish. We have few signs, big picture, of a breakdown and selling under the surface. I do see interim selling and breadth breakdown that helps me position clients, you know, short for a few days or a few weeks, but I'm talking big picture. Fed Treasury liquidity flows, it's basically an indicator that I use, is still there. It hasn't, you know, fallen out. Option flow is still stupid bullish if you are into quantitative analysis. Oh my God. And NVIDIA makes the market. By the way, 60% of NASDAQ gains, this is no joke, of NASDAQ gains in 2024 are completely thanks to NVIDIA, right? So we have a situation where we continue to have breadth, which is underneath the surface. SPX 493 is doing much better than just the MAG 7. VIX is already below its 200-day. By the way, this was written back on November 9th, but it still applies, right? 10-year yield and the dollar are still in a Goldilocks zone, which for equities is below 107 for Dixie and 4.4% for the 10-year and above 3.8, which is also key. If it falls too low, we also have selling. Gold is in that Goldilocks zone. Jobless claims are also still under 267,000, which is key for me. And employment rate is below 4.5%. Trump has clearly won, and he's got a mandate. He promises tax cuts. He promises fewer regulations. He promises peace, right? We'll see. And fiscal restructuring with U.S. jobs coming home. Oh my God, no wonder the market was so excited when he came in, right? But there's a lot to do here. There's a lot to do. So I wanted to kind of just go over some of the Trump trade, both macro, break down still how the situation is still doing fairly well, but I have some concerns, and we'll kind of end that and take any last kind of questions. But the macro recession risks for 2025 do not go away. They were in place before my call that Trump would win, or the fact that he even did win, right? So my baseline bet is that even if they deliver on a lot of these programs that they've talked about, cutting war spending, oops, I got to put this in yellow, corporate welfare programs, really, if they get rid of a whole bunch of pork, it's still not going to remove the fact that they have an economy right now that is based on money printing, lots and lots and lots of government money printing, QE, monetary policies that totally suppress price discovery and volatility. So this is the big thing. If we're going to have this smooth transition of planned devaluation of the dollar under Trump, right, which is bearish foreign holders of equities, which equates to 17% of just US equities, then you're going to have to kind of keep in mind that some of that money is going to go home. And the other big kind of warning is that this market is whacked. I mean, we have had parabolas after parabolas the past week that you see in MicroStrategy and Bitcoin and the rest, but this is kind of a behavior of a child that's overtired, about to crash, one last sugar-fueled manic move higher. So if we have a melt up in the market itself, and we've already played some of these really, really well. This NVIDIA, right, gorgeous, up 8,000%. This Tesla, gorgeous. I mean, we play this. This is all very, very, very playable. But the point is, this becomes unstable. Parabolas equal trapped longs. Everyone becomes too overconfident. And then any trigger, macro trigger, can, in fact, create such volatility that it triggers liquidation. And you don't want that for our market. So the point is, we've got lots of things that they're promising, and we've got a backdrop right now that is conducive for continued rally. Just keep in mind the fact that this is what they're trying to do, is devalue the dollar for our prosperity. And we wish them, smooth, smooth sailing, but I don't think it's going to be smooth. I think we're going to have some disappointment along the way. And I think at some point, inflation, which is equities, right? The way that we're manifesting inflation right now is through our assets. We all know this. There'll be a battle at some point between those who are front-running tariffs, or the dollar devaluing, whatever. They're gonna try and kind of front-run this policy interference that we've had by Fed and Treasury, these entrenched U.S. deficits, all this sticky inflation. It's all going to come together. And we're going to have a situation where the folks are going to kind of wake up and say, wait a minute, we actually have a government that's shrinking. That's their goal. We actually voted for this stuff, but the whole stock market is based on the inflation that is the government. So with that, thank you very much for listening. I basically am excited about macro, as you know, and I have a team that, of course, does everything from stock selection, sector rotation to macro. We have a service that is both for beginners, intermediate, and advanced. I'm obviously talking about some of the more advanced concepts, but I'm happy to talk about it because it is so timely. It's
All right, so yeah, I put the link in the chat. Oh, Kimmy already subscribed to her YouTube channel. Yeah, you can go to Leduc Trading. I think, I mentioned to Master Kim, like, if you have a lot of money, you just don't have time to study charts and things like that, it's better off you. I would probably recommend her. I mean, I haven't really seen anyone else that does such a great overall, like, I mean, she has a good team, and yeah, I don't know. I haven't seen anybody else pick out tops and bottoms like her, like, really that well, with the whole package. She has a whole package. A lot of people just have, like, kind of like, oh, they'll just teach you how to trade or something like that, but she actually has things for different levels of people. So, and yeah, I think she has a good macro sense, micro sense. So she's also trading and also looking at the economic things. And it's rare. I think that's very rare. A lot of macro people, they get kind of too egotistical, in my opinion. A lot of people get kind of stuck in their thesis. They really just want it. Honestly, they just want their thesis to be correct, even when there's signs that it's not correct. It's just more of an ego thing, And since she's a technical person, she'll look at the charts and based off of that, go from there. So yeah, I think a lot of people do want to be at that level. Yeah. I have the Buffett. Yeah, we'll have to discuss that, Kimmy Cakes. We'll have to go through it. So, right now I've just been testing out, like, trying to give people more day trades, which I don't personally try to do, but I've shown examples this couple weeks where it's like, it's easy. Yeah, the stuff I teach you can be applied also to day trading. So it's not also for swing trading or investing. It can be done. So, and then by December, I'll try to make some model portfolios, try to, like, show you how you do it with just basic ETFs and try to rotate. And I'll try to see if I can beat the S&P 500 by 5 to 10%. If I can consistently beat the S&P 500 by 5 to 10% every quarter, at least every quarter, by rotating around different sectors and stuff, that's really good. That's like amazing performance. And you'll see, like, oh man, I could do this myself, do this and that. Yeah, hopefully that's what I want to do. Yeah, that's how it is. You gotta go into it. And I think the first thing is you want to actively manage your portfolio, Kimmy. It's like, before you do trading. Like, if you do trading, you're just gonna, like, probably practice with a few $1,000. You go, like, all right, let me see how it works here really quickly, and then you scale it up. So you take your 50K and you'll be like, all right, let's try to make some things long term. For me personally, what I do is, what happened was, I was a long term investor. I would just take a few thousand here and there, wait 10 years, goes up. And then after I built enough capital and I went to work, what happened is, I think the jump was not for showing after I was trading, since it was a 1D view. You could do different interval. Was there a jump? No, that's no tropes. That was SMCX. TradingView has some issue with SMCX. I wasn't showing SMCI. SMCX is a leverage ETF that does 2x SMCI. So that's a problem. There's a problem with the no, that's an error. That's an error. No, I've seen this. Last week it was just one day it was gapping up. And then this week is I see like 3-4 things. No, there's something wrong with how like go anywhere else and look up SMCX. No, yeah, SMCX should be tracking 2x SMCI. Yeah. There's a glitch in like TradingView. Yeah, well, whatever. Go somewhere else. Go to Robinhood or like Thinkorswim or something. Anyway, yeah. So Kimmy, we'll have to go through it. So everyone has their own preference and things. My preference is I only trade with like maybe up to 100,000 over a quarter. And right now I'm like 50 G's up for this month. I'm going to have to decide like, I'm going to take away those 50 G's. So a lot of people would be like, they would keep trading with the money they made and try to compound it. I don't like doing that personally, like with that much money. It's like people, like theoretically, you can go, okay, let's say you can do 2% every week, right? You can compound it. That's still hard to do. Like making consistently 2% every or 10% every month and then compound. Like a lot of times you're going to get into, so like this month has been really good. Okay, I made 50 G's from like 90 or 80,000. But 60, probably 60 now or 70 after today. But like that's rare, right? Okay, I'm not gonna say like, oh, I made fucking 100% gain in a month. No, that's not normal, bro. So you're gonna have good months on the good times, and you're gonna have like so months where you're like middling around. You're not gonna have every condition like right now after Trump and all the Bitcoin stuff, and then all this like other things happening all at once in November. That's rare. Okay, so that's why you have to recognize what happens, and you're like, okay, this is a good time to get in. That's why I've been promoting all these penny stocks and all this trash on the scrolling around at the bottom of the screen, is because the conditions are good now. But when the conditions are bad, you would scale down and be like, you're not going to take that risk. You're not going to be going into those type of stocks. But when the conditions are good, you're like, okay, I'm going to take more risks. I'm going to do that because the conditions are right. So this is something I also have to try to focus people on, is like, look at the conditions. If the conditions are right, you'll take more chances on a trade like SMCI or something like that. But if it's not good, no way would I do it. I'll just be like, shit, no, that's the risk reward is not going to look good. And I haven't quantified that stuff. I wish I spent some time trying to figure out a way to like, okay, some AI or something would just tell you, oh, this is not a good condition, right? It's sort of like the weather, it's like when people sailed in the old times, like, did people know that the weather was right so I could go put up my sail and go sailing across the Atlantic? It's like, that's how you should treat it. It's like you can't really predict the weather to an exact way, but you can kind of get a feel for it. Oh, I know it's summer. At least I know that. I know it's winter. I know that. If I know if it's La Nina or El Nino, that's even better, right? So like the more information you can get and the conditions, you can trade with a better risk management. That's something I got to work on to try to figure out how people should evaluate that. The evaluation is the problem, because it's not an exact science. It's really, right now, it's just like an art. Most of the time I just look at some charts and I'll just guesstimate, okay, this looks right, I'll do it. But then sometimes I'll just look at it and be like, oh, it's not right. But that's not quantifiable, right? So you really don't need to know. It's mostly like you'll see a pattern and you'll say like, this has worked before, and you'll take a chance based on some other secondary indicators like HIMS. If I look at HIMS right now, I took a chance on that, because I've seen the repeating patterns on it. Let's see. Like, but it's really risky, right? Because HIMS moves violently. It's a biotech stock. And the reason why is because, look at the 65. You don't see any pattern here. You don't know what's going on. But if I look at the weekly and the daily, you'll see something. So if I look at the weekly pattern, you see it keeps dipping right into that moving average. The trend is moving up since February, and the weekly looks good. And then when I went to the daily, you see it repeating. The daily is moving up too. So when you see in two patterns on the daily and weekly, it's moving up, then I'm more confident. Now, another way you can say it's more confident is let's look at the biotech sector itself. Biotech has been moving sideways since March and whatever, but HIMS has been moving up. And the XBI had tried to get breakout on November of 11th, right? Before the whole options expiration, JFK stuff. And now it's recovered. That's why I took the chance and added more on this. So that's why when you look at it, you say like, hey, this whole sector hasn't been this bullish since the COVID move in 2020 to 2021. And now we're breaking out. So that's why I'm going to take more risk. And what it's going to do is, if this breaks out, if XBI starts really breaking out, I'm going to be even more bullish on HIMS. So you look at a stock within the sector, you look at the other stocks within that area, and you say like, this is outperforming the rest of the sector. The sector is moving up. And then I was talking over Sunday, I played that video about small caps. Small caps is already broken out. It's doing well. Mid caps breaking out. It's already broken out since the December 2021. Yeah, that's it. That's enough. I got to say the conditions are good. I'm going to take a chance. If it wasn't like this, I wouldn't have taken those chances, right? So you got to look at it on a surface level, and then you go into a secondary level, and then you can go further. And I could probably do a cycle analysis of this, right? And say like, what are the cycles looking for small caps and mid caps, and say like, hey, it's a good time to buy small caps again. So we'll see. So I gotta go through that. Okay, crack. Oh, what do you think about Walmart? Yeah, Walmart does look good. I think it does look good. I mean, it's just kind of overstretched right now. You know what I liked was recently the Deere earnings. Like Deere, like I know people are worried about the tariffs. Like Trump was threatening them with 200. Somebody was asking me about that. Like, what about the tariffs for Mexico for 200%? Because Deere is shipping some of their manufacturing to Mexico, and Trump is threatening 200%. But if you look at the way it's moving now, after earnings, it's broken out. Man, it's been in this sideways motion since May of 2021, and it's finally so. Yeah, there's a lot of companies like this. Boeing too. Like, I mean, yeah, Boeing, you got a lot of issues with Boeing, but like I said, it's been defending this 140, 150 area. If you need a blue chip stock, well, let me see. I like this one. This GE one, GEV, GE Veranova. So GE split into three companies, GE Healthcare, yeah, and then GE itself, aerospace. Now it's just aerospace. I mean, GE is really a turnaround company because they broke apart into each individual company, and each broken piece is worth way more than when they were together, in this big corporate thing. So it's tough. Yeah, Volvo, Kimmy. Oh man, Volvo is like, I think it got bought out by China or something way back when. Yeah, I forget. A lot of those European companies, they just sell off all their pieces to China. Man, Europe really just like really got connected to China really too much. Yeah, I mean, man, I followed GE back in the day. The previous CEO was like amazingly bad. Like he did all the things wrong. I mean, they should just make books on like big companies like GE, IBM, Intel, and go over the CEOs that really trashed up their companies. A lot of the issues with GE was because of finance. Actually, there was a subsidiary of GE called GE Capital. So they actually spent more time trying to give loans to smaller companies through GE Finance than actually building stuff. You know, GE is just supposed to be building generators and electric parts and motors and airplane engines and nuclear, but they started spending so much time making the easy money in the finance. And that's the same thing with Intel too. It's like when the finance department takes too much control of the direction of a company, it's just like, because financial engineering is such an easy way to make money in a company. And so you spend more of your efforts trying to like boost up your balance sheet rather than growing the company. That's really how it goes. Like a lot of people, yeah, a lot of companies, big companies, they go for that. Anyway. And so is Africa. Yeah. There's a lot of Chinese and Chinese in Africa right now. Oh man, but let's see what happens. Intel, let's see. I mean, it's been trying to hold this area between $19-25. I was thinking like maybe it could go down further if there was a crash, but I don't think there's any crash coming anymore. It's done. So if you can get Intel at near $20 again down here, that'll be great. But I doubt it. Maybe it can go down to 22. You probably can scoop up some shares. If you need a blue chip company in your portfolio, that's probably one you could hold long term. But no guarantees. I think in 2 years we'll see some issues with the financial markets. The home building sector has a 18 and a half year cycle. So we'll go over that sometime down the line. I have a presentation to show you guys with that one. But yeah, Bitcoin. Let's see what Bitcoin's doing. I think Bitcoin has recovered a bit. We'll have to see if it can recover 93,000. That's key. It's trying to, but no guarantees tomorrow. MSTR, like I said, yep. If you want to do leverage, MSTU is one way. MSTX another way. 2 ETFs, you can do 2x leverage. I've tentatively bought it. I did say on Sunday I was targeting 325 on MSTR to keep shorting it, but I'm changing my mind. I think like maybe it's gonna stop here. It won't go down, but you have to keep your options open because Turkey Day, it might have a flash crash into Black Friday to 90,000 or a little bit below it before recovering. That's possible too. Like you're gonna have gravy, you're gonna eat gravy and stuffing, and then you're gonna see Bitcoin, and all the people start freaking out and they go on their phones and start selling. Yeah, right. Yeah, Kimmy, yeah, that's good. So yeah, you should build like a set of good like stocks to buy. I mean, for me, my long-term plays have been Palantir because it's just like AI, drones, military, and then you have Axon body cameras, right? Like everybody's just playing body camera videos all the time. It's like, why don't you just buy the stock? You know, just buy the stock. Yeah, this thing has been doing pretty good. Those are my two like favorite ones to play outside of just like playing the index. Most people should just play the index, S&P 500. But yeah, cannabis, I've been watching that. The problem was if Matt Gaetz was into it, I mean, I see it's trying to recover. You see this? So this is the MOSOS is the ETF. It has the problem with US, you have to do US cannabis. Canadian cannabis businesses are terrible. They're overtaxed. They can't really make good margins. The margins are so thin. So it's really hard to make money being a legal Canadian cannabis company. So you got to look at US cannabis companies, and they already have a hard time as it is. But since they're always underperform because they're all penny stocks. So MSOS are penny stocks. They can't even trade legally on the NASDAQ. So you use this ETF, you can track all of them together as a bundle. You see when Trump got elected and the GOP won the House and the Senate, you see it all crash down here Monday, November 11th. And then when Matt Gaetz was coming in, and then Ted Cruz, or not Ted Cruz, what was his face? From New Jersey, Chris Christie was saying like, oh, you know, we're not going to be anti-cannabis or whatever. And then it just pumped it up temporarily and then it came back down. Yes, I would be looking into it. This could be a potential play, but you know what's better than that, Kimmy? Is psychedelic. So I'm in MindMed. I've been buying a lot of that since $5.70 and again at $6.70. And then there's another one called Atai, ATAI. So MindMed is MNMD and Atai. So psychedelic. I'm watching ATAI to see if I can get a good entry here, because Atai is owned by Peter Thiel, and you know Peter Thiel is pretty much a friend of a lot of the people coming into the new administration. So yeah, so mushrooms, acid, all that stuff, DMT, you know, for depression. MindMed has a real good MindMed already has moved up because of FDA approval. So it's already been moving up since $2 since last year. And it came right down to the support area here, $5.70, bounced right back up. I'm like, oh shoot, this thing is gonna hit 12, get over 12, and it's just shoot right back up. I mean, I'm not gonna say it's gonna go back up to the old highs of $60 from $8 or whatever, but I'm just saying the conditions are right. I think that, yeah, everything's right. ATAI is another one, but the problem with ATAI, it's definitely a penny stock. ATAI doesn't have any FDA approval, nothing. It's only got the backing of Peter Thiel. So, you know, if you need penny stocks to put in your IRA, these are the stocks that you want in your IRA, because you never know when, like, you know, you want this to go 10x. This could just, like, if your IRA is like really small, you know, you could just put a few thousand in here and be like, oh, 10x. That's my $3,000 position becomes $30,000 or something like that, right? Whatever. So it's a good way to do that, unless you have options. I don't know. Some people have IRAs in options. Yeah, microdosing is definitely a thing. Definitely Silicon Valley, definitely a thing. So yeah, look at that. Body cams, yeah, AI is the future. Yep. So we have to discuss more about that. A lot of AI stocks also is nootropics. Yeah, I think that's part of the same thing, but I'm not sure if there's any companies that really focuses on that. Maybe ATAI does. I haven't looked into it myself personally, into the fundamentals, but I follow these ones. There are four of them. The other two is CYBN, Cybin, and Compass Pathways, CMPS. These are worse than the other two. So the only ones I recommend is MindMed, because it has FDA approval at least of one of their drugs, and ATAI, Atai Life Sciences, only because of Peter Thiel. And Peter Thiel hasn't done me wrong. I got Palantir, you know, Palantir also do all that stuff. Yeah, my old boss, microdose. Yeah, all right. Yeah, all right. I'm not gonna report OSHA on this stream. All right. Okay, guys. Yes. So support the channel, donate to Portia, and we'll see you guys later. I think Lolo's on the other stream still, so yeah, you can go watch her, or you can go to Ava and Ruby stream. A lot of women streaming right now as I stream, so we got lots of time. Tomorrow, hopefully, I'll try to update you guys through Thanksgiving, because I'm sure. What about spices like salts? What the heck? Salts? Nah, we're not gonna talk about that. No, we're not talking about that. Unless we could talk about like lorries or something. I don't think. Yeah. All right. I'll see you guys. Yeah. Later. Let me play the outgoing ad. I love this ad.
Feel like I should go. Feel like I should go. like I should feel like I should feel like I should feel like I should feel. Feel like I should feel. Like I should feel like should feel like should feel like I should.
Feel like I should go.